Yesterday we talked about market structures. I introduced the main characteristics of market structures, and we also focused on perfect competition. The main objective was to describe the characteristics of this market structure, the assumption that characterize perfect competition. We spent some time to understand the shape of the individual demand curve in perfect competition. Why is it horizontal? How can we explain it? And we also talked about the equilibrium in perfect competition, the short-run equilibrium, when we have a fixed number of businesses, and the long-run equilibrium, when firms have sufficient time to enter or exit the market. Today, we will finish this topic of perfect competition. There are three main things that we need to discuss. We need to talk about the concept of shutdown price in the short run and exit price in the long run to explain what this means. And we need to talk about efficiency in perfect competition. Do we achieve allocative efficiency? Do we achieve productive efficiency in the short run, in the long run? And finally, we need to talk about supply curves. Individual supply curve from the point of view of one individual supplier, and also market supply curves from the point of view of the entire industry. And again, it might be useful to distinguish between the short run and the long run. Finally, I will show you one exercise that you can do with your students to summarize most of the key concepts related to perfect competition. Okay? Do you all hear me well? Is this okay? Are we ready to start? Okay. Right, so let's start with this concept of shutdown price. So the first thing that we should do is to understand what a shutdown is. Shutdown is simply a situation in which a business stops to produce for some time. So the quantity supplied is zero for some time, but it does not mean that the firm is leaving the industry. The typical example that you can give is in the service sector, especially in touristic areas. There are hotels that are only opened at one time of the year during 1 or 2 seasons, simply because the demand is highly seasonal, and it's better for these hotels to remain closed for some time, and they will wait the tourists to come back before they reopen. You also have the example of ski resorts. Obviously, when there is no snow, you have all the restaurants, the hotels, the stores in which you can rent ski equipment, for example, that are going to shut down during spring and summer, simply because there are no customers. So this decision of shutting down is a temporary decision in which a business is going to stop producing. And it's a decision that a business can make in the short run. So what do we call this shutdown price? The shutdown price is simply the minimum price, the minimum market price, below which the firm is better off shutting down. Which means that when the market price is below the shutdown price, the quantity supplied is zero, and the firm will accept to produce, will start to produce, it will stay open, if you want, only if the price can stay above this shutdown price. This is really the first thing that you should say when introducing this concept of shutdown price. Okay, so let's just summarize the main ideas. So in the short run, a firm shuts down, which means temporarily suspends production. if the price falls below the minimum of the average variable cost, not total cost, which we call the shutdown price. Okay, so you can start with this statement, but it's important to explain why it is the case. Why not the minimum of the average total cost? And there is a very simple way you can explain it. So remember that we are here in the short run. So in the short run, when we study perfect competition, there are two things that we should keep in mind. We should keep in mind that the number of businesses is fixed. Basically, firms do not have sufficient time to enter or exit the industry. And you also have some fixed costs, in the sense that in the short run, capital, the amount of capital that businesses have hired, this amount is fixed. Remember that in the typical model, the typical production function, you only have two factors of production, capital and labor. And in the short run, the quantity of capital is fixed, whereas the quantity of labor is variable. So in the short run, if a business decides to shut down, well, this way, this business will be able to eliminate all variable costs. Think of a hotel. If you have a hotel that makes the decision to shut down, this hotel can just ask all the employees to leave, and in this way, the hotel will not have to pay wages during the period of time during which it will shut down. So the bottom line is that when we shut down, we can avoid variable cost, because we produce an output of 0, and if we produce an output of 0, there is no variable cost. But even though we do not produce anything, we still have to pay fixed cost by definition. Fixed cost is a cost that is the same regardless of how much you produce. You can produce 10, 20, 50, 200, 2 billion, or 0. You will still have to pay the fixed cost. So you can eliminate variable costs, but not fixed costs. The point is that it doesn't matter what you do as a business. It doesn't matter whether you choose to stay in business, stay open, or whether you choose to shut down. In both cases, you will have to pay the fixed cost. Okay? So when you have a decision to make, you have two options. And when in each option you still have to pay the fixed cost, then we will agree that in this case, we should ignore this fixed cost, because it is there in both options. It's not something that is going to help me to decide whether or not I should stay in business or not. So this is what I explain here. Therefore, the fixed cost should not be considered in deciding whether to produce or to shut down. Okay, the fixed cost is sunk. It has already been paid in the short run. And whatever we do now, there is no way we can recover this cost. So we ignore it. And that's why the shutdown price is the minimum of the average variable cost. We need to cover at least the variable cost and not the average total cost, because the total cost takes into account the fixed cost. But in the short run, we should ignore it when making the decision of whether to stay in business or to shut down. So this is the intuitive explanation of why the shutdown price is the minimum of the average variable cost. But there is another way you can do it. Okay, and then I explained that these shutdowns are common in industries whose demand is highly seasonal, should actually come before. And there is, this is usually what I do with the students to explain why, the shutdown price. Basically, what you have to do is to compare the profit that the firm is going to make if it shuts down and if it stays in business. Okay, so if we shut down, of course, we don't sell anything. So our total revenue is 0. But the advantage, if we shut down, is that we can avoid all variable cost. The variable cost is 0. But as I explained, we still have to pay the fixed cost. So if I shut down, total revenue 0, minus variable cost 0 minus fixed cost. So my profit when I shut down pi 0 is equal to minus the fixed cost. It's negative. Basically, it means that I am going to lose money if I shut down. Okay. What if I stay in business? Stay open, I keep producing. So if I keep producing, I will receive some revenue from my sales. I will receive the total revenue, but I have to pay the cost of production, which includes both variable costs and the fixed cost. So in this case, my profit is just total revenue minus total cost, which is TR minus the two types of cost, variable cost and fixed cost. Okay. So then we can just compare in which case is it better to stay in business? Well, if this second expression is greater than the first expression, okay? The firm is better off staying in business as long as capital pi, which is the profit when I stay in business, is greater than pi 0, which is the profit when I shut down. And you see, and this is what is interesting there, is that the fixed cost cancels out because it's there. You have minus FC in both expressions. So you see that it does not, you don't have to take it into account when you make the decision of whether you should stay in business or whether you should shut down. You should just see whether your total revenue, TR, can at least pay your variable cost. And if I divide this inequation by Q, if I divide by the quantity on each side of the inequation, TR divided by Q is the average revenue, which is also the price, okay, which is the price. And the variable cost divided by the quantity, it is the average variable cost. So you see that as long as the price is above the average variable cost for at least some quantity of output, then I am better off staying in business. But if the price is lower than the average variable cost for all levels of output, then I am better off shutting down. Okay. So the intuition is that if the total revenue is greater than the variable cost, or in other words, if the price is greater than the average variable cost, this is equivalent, then it means that the firm can cover all variable cost and at least a fraction of the fixed cost. So even if we make a loss by staying in business, this loss is going to be smaller than the loss that I would make if I decided to shut down, because if I choose to shut down, my loss is equal to the full fixed cost. All right? Okay. So if it shuts down, the firm has to pay the entire fixed cost. But if I stay in business, when the price is greater than the average variable cost, I can pay at least some of this fixed cost. And of course, I have not mentioned it, but if the price is greater than the average total cost, then I cover my variable cost and I also cover my fixed cost, all of it. And in that case, I make a positive economic profit. Okay? So how do we represent that on a diagram? So these are my typical curves, MT, ATC, AVC, and this is the market price. I am price taker. I have no influence on this market price. And the firm, okay, let's just put it this way. The firm maximizes profit when MC is equal to MR. So that's going to be the profit maximizing quantity, okay? And at that quantity Q1, this is my average total cost of production. Now, let's identify some areas. Let's identify total revenue, total cost, variable cost, and so on. So, and my average variable cost is there. What I can see on this diagram is that the total revenue is there. It's represented by this area, simply price, P1, times quantity, Q1. Whereas my total cost is equal to this bigger rectangle, average total cost times quantity, ATC1 times Q1. So you see clearly that my total revenue is smaller than my total cost, which means that if I stay in business, if I choose to produce Q1, I am going to make a negative profit, and I can identify it. It's there, right? This is the amount of money that I would lose if I decided to stay in business. Total revenue minus total cost. I can further distinguish, this is my total cost, right? And this total cost is can be divided into my fixed cost and my variable cost. My total variable cost is just the average variable cost times the quantity. And the fixed cost is just the average fixed cost, which is the vertical distance between the AVC and ATC times the quantity. Okay, so I can identify the two components of my total cost. So what does it mean? If I stay in business, I lose this. This is the loss if I stay in business. But if I choose to shut down, I'm going to lose the entire fixed cost, which is there. If I shut down, I still have to pay the fixed cost, so this is what I lose. So you see that in that case, even though I make a negative economic profit by staying in business, it is still better than shutting down, simply because I would make a bigger loss. Okay. You can put it this way: your profit is less negative if you stay in business than if you shut down. So this is how you minimize your loss. Minimizing your loss is the same thing as maximizing your profit. You minimize your loss in this case if you shut down. Okay, good. So yeah, so the shutdown price is simply the minimum of the average variable cost. As long as the price is above this level here, the minimum of the average variable cost, you will always have at least one level of output at which you can cover at least your variable cost. So at least a level of output at which you will be better off staying in business. To put it differently, as long as the price is above the shutdown price, the profit maximizing level of output will be such that your profit will be bigger than minus the fixed cost. So you should stay in business. But on the other hand, if the price is lower than the shutdown price, then if you stay in business, the profit that you will make at the profit maximizing quantity will be smaller than minus the fixed cost, so you should shut down. You will not even be able to cover your variable cost. Okay, now, so shutting down is a short-run decision. On the other hand, exiting an industry is a long-run decision. Choosing to leave the market once and for all, this is a long-run decision that businesses can make. Remember that in the short run, the number of firms is fixed. So it's only in the long run that they can choose to leave an industry. And the only thing that is going to be different between the short run and the long run is the fact that in the long run, and this is something that is related to production, all factors of production are variable, which means that firms can adjust the quantity of all factors of production. Again, if we focus on capital and labor, while capital was fixed in the short run, capital, or the quantity of capital, becomes variable in the long run. And the consequence is that you don't really have a fixed cost in the long run, simply because you can choose how much capital you want in the long run. So depending on the quantity that you want to produce, you will choose a different quantity of capital. It's a bit different to say that there are no fixed costs. It would be more precise to say that you can choose your fixed cost in the long run, but it's okay. Let's just say that, to simplify, there is no fixed cost. So if there is no fixed cost, in this case, if you choose to leave the market, you will not have to pay any fixed cost, which means that if you choose to leave an industry, so you produce zero and you are gone, you don't have to pay any cost. So in that case, of course, if you leave the industry, you will not receive any revenue from your sales. So your total revenue is going to be equal to zero, but your total cost is also going to be equal to zero. So this is the only thing that is different from the short run. And the consequence of this difference is that in the long run, a firm is going to exit a market when the price falls below the minimum of the average total cost, whereas in the short run, the firm shut down when the price is below the minimum of the average variable cost. Again, what does it mean? It means that in the long run, for a firm to stay in the market, it has to cover all its costs, all costs in the long run, both fixed cost and variable cost. Again, you should not say that there are no fixed costs in the long run. You should say that you can choose the size of the fixed cost. It's a bit more precise to put it this way. So these businesses, they must cover all their costs, so they must make at least normal profit, at least zero economic profit. Okay, let's see how we can explain it, or how we can use mathematics to prove it. If I leave the market, as I said, my profit is zero. I don't receive any total revenue, but there is no fixed cost that I have to pay, and therefore my profit is zero. If I stay in business, well, I receive revenue from my sales, but I also have my total cost of production, total cost. In this case, I am better off staying in the market as long as total revenue minus total cost is positive, which means when my total revenue is greater than my total cost. And again, if I divide this inequation by the quantity, it's equivalent to average revenue, which is the price of the output, is greater than the average total cost. So you see that in this case, as long as the market price is greater than my average total cost, at least for some level of output, or to put it differently, if at the profit maximizing quantity, if the price is greater than the average total cost, then the firm is better off staying in the market. Okay, so the exit price in the long run is there, the minimum of the average total cost, and the shutdown price would have been there in the short run, the minimum of the average variable cost. Okay, is this okay for everyone so far? Any remark, any questions that you may want to ask before we move on? Feel free to type any question that you may have, if there is anything that is not absolutely clear. Okay. So this shutdown price and exit price was the first topic that I wanted to discuss today. Now let's have a look at efficiency. And more precisely, let's have a look at allocative and productive efficiency. So the best way to see that is to go back a bit to the diagrams that we discussed yesterday. Let's have a look at this one. And look at what happens in the short run. Do we have allocative efficiency in the short run? Do we have productive efficiency in the long run? And to reach conclusions in terms of economic efficiency. So the first thing, let's start with productive efficiency, because it's usually very straightforward. So remember, there are two different definitions of productive efficiency. There is productive efficiency in the economy, when it is not possible to produce more of one good without producing less of another. If you use a diagram, this is represented by a point on the production possibility curve. But this is not the definition that we are going to use here. We are not interested in productive efficiency in the economy. We are interested in productive efficiency in a firm, in a business. And the definition of PE in a business is when this business produces the quantity of output that minimizes the average total cost curve, okay, this green curve. So if this business, this individual firm produces the level of output, the quantity at which the ATC is minimized, this would be right here, then we would say that this business achieves productive efficiency. And the first thing that we can see on this diagram is that you see that this business does not achieve productive efficiency. In particular, you see that it produces a level of output that is greater than the productively efficient level of output. Let me just identify it. The productively efficient level of output would be right there. Let's call it QPE. All right, this would be the productively efficient level of output, but the firm does not produce this level of output, so productive efficiency is not achieved. That's it. Then what about allocative efficiency? Allocative efficiency in a market is a situation where total surplus is maximized. To me, that's the easiest possible definition. When you maximize total surplus. And if you want to maximize total surplus, it must be the case that the marginal benefit of consumption is equal to the marginal cost of production. So when we look at the right-hand side diagram, the marginal cost of production is represented by this red curve, no problem. But where is the marginal benefit of consumption? Well, I'm not going to make detailed explanations because the topic of today is not about efficiency, but you probably know that the marginal benefit of consumption is given by the demand curve. And the demand curve, the individual demand curve, is simply this horizontal line, okay? This horizontal line, this is the demand curve. So that's your marginal benefit of consumption. I can add it. Let me just add the text up. All right, that is my marginal benefit of consumption. So at Q1, which is the quantity that we produce, that this business produces, do we achieve allocative efficiency? Yes, because we see that at Q1, the marginal cost of production, this red curve, is equal to the marginal benefit of consumption, the blue horizontal line. So yes, we do have allocative efficiency. And this is something that is always the case in perfect competition. Firms, or perfectly competitive firms, always achieve allocative efficiency, but in the short run, they do not achieve productive efficiency. We see that right there. How about in the long run? Do we still have allocative efficiency? Do we still have productive efficiency? Okay, so let's move to the long run equilibrium. So that is the long run equilibrium. Do we have productive efficiency? Yes. We see that in the long run, this business does produce the level of output, Q2, at which the ATC curve reaches its minimum. So this business achieves productive efficiency. Do we achieve allocative efficiency? Yes. Again, the marginal cost of production is always represented by this red curve, so it's there. And the marginal benefit of consumption is given by this individual demand curve right there. So at Q2, the marginal cost of production is equal to the marginal benefit of consumption, and therefore this business achieves allocative efficiency. Or more generally speaking, allocative efficiency is achieved in a perfectly competitive market. So there is something quite interesting that we can say. We see that in perfect competition, allocative efficiency is always achieved. By always, I mean that it is achieved in the short run and it is achieved in the long run. But productive efficiency is only achieved in the long run, not in the short run. So the conclusion, you can draw a conclusion in terms of economic efficiency, because you know that economic efficiency requires both allocative and productive efficiency. You can say that perfectly competitive markets do not achieve economic efficiency in the short run, because we don't have productive efficiency, but perfectly competitive markets do achieve economic efficiency in the long run, because we have both productive and allocative efficiency. And that's it. That's all we have to say about efficiency. We can summarize it. Okay, so here you have a summary of the different types of efficiency. I'm not going to review that. And here's the conclusion. In the short run, we have allocative efficiency, but we do not have productive efficiency. Therefore, we have economic inefficiency. In the long run, however, we have allocative efficiency, we have productive efficiency. So overall, we do achieve economic efficiency. And that's all about efficiency in perfect competition. But it's important that your students, especially in essays about perfect competition, it's important that your students can describe these properties in terms of efficiency. Okay, that's it. Very fast, you see. Questions about before we move on to the last topic, before we move on and talk about supply curves? No questions? Okay. So the last topic is the concept of supply curve. Something that is quite interesting that I want to mention is that among the 4 market structures that we study, perfect competition, monopoly, monopolistic competition, and oligopoly, perfect competition is the only market structure in which there are supply curves. There is no supply curve in monopolies. There is no supply curve in oligopoly, and there is no supply curve in monopolistic competition. Why? Simply because the concept of supply curve only makes sense when businesses are price takers. If you are price maker, the concept of supply curve does not make any sense. Simply because what is a supply curve? It's simply a relationship between a market price that you take as given and the quantity that you want to sell, to supply, to maximize your profit. So when you talk about supply curve, you assume that the business is price taker. In a monopoly, firms are price maker, so they do not take the price as given, and therefore there is no supply curve. And that's why the only market structure in which we talk about supply curves is perfect competition. Okay, let's define it. So a supply curve indicates the quantity of output that a price-taking firm or industry, because we can have an individual supply curve or you can have a market supply curve, is willing to offer to supply at any given price in order to maximize profit. That's the typical assumption that we make. Firms make decisions to maximize profit. So in order to understand how we build the supply curve in perfect competition, there are a few things that we need to summarize. First, optimum output rule. Firms maximize profit when MC is equal to MR. This is called the optimum output rule, and this is always the case. Always the case means that it's the case in any market structure. MC is equal to MR, we maximize profit. But there is something that is particular to perfect competition, is since firms are price takers, then the marginal revenue is equal to the price. We do not need to cut the price in order to sell more output. We can always sell more output at the market price, and therefore, every time I sell one more unit, my total revenue increases by the exact amount of the market price, so the marginal revenue is equal to the price of the So it means that basically the condition that maximizes my profit is MC is equal to P, market price. Something that you can add if you have students that are a bit more advanced, you can say that MC is equal to MR is a necessary but is not a sufficient condition. Let me try to explain that as simply as possible. Okay. Related to mathematics. Okay, so let's say we have, it's a bit complicated. Okay, let's just say X. Let's do some basic math, and f of x. Okay, and I'm going to draw a curve. Ooh, it's a bit too thick. Too still. Okay, give me a sec. It's going to be better. Yes. All right. And this is a curve that represents C of f, this function. You know that if my job is to find the extrema of this function, the maxima and minima of this function, what I do is that I calculate the gradient or the derivative. I take the derivative, and I solve the equation. The derivative f prime is equal to 0. And I would find two solutions in this case. And this is what is interesting. I would find one solution right here, and I would find one solution right there. And one is going to be a maximum, and the other is going to be a minimum. And this is exactly the same thing when firms want to implement the rule MC is equal to MR. MC is equal to MR is just a first order condition. It just basically gives you that your profit function reaches an extremum. But this extremum can be a maximum or it can be a minimum. So you have to make sure that when you try to maximize your profit, that you don't actually minimize it, because the quantity of output right here that minimizes, let's say that this curve represents the profit. So the quantity of output at which your profit would be minimum is also such that MC is equal to MR. So we have to be careful. It's just a first order condition, but if we want to make sure that we have identified a maximum, the quantity that maximizes my profit and not the quantity that minimizes my profit, I need another condition. I need a second order condition. Don't worry if it's a bit too advanced. You don't need to teach that to your students, but to me, I think it's important to keep this in mind. Yeah, so. And we also said, when we talked about the shutdown price, we said that the firm is going to shut down as soon as the price falls below the minimum of the average variable cost in the short run. And in the long run, the firm will exit the market when the price falls below the minimum of the average total cost. Okay, so now we have everything we need to describe the supply curve in perfect competition. We know that the level of output at which MC is equal to MR maximizes the firm's profit if, and this is what is important, only if the marginal cost curve is increasing. If your marginal cost curve is decreasing, then the level of output at which MC is equal to MR minimizes your profit instead of maximizing your profit. Okay, so you might have the proof, but I don't want to say too much about that because it's a bit advanced. But just keep this in mind. If you want to make sure that you actually maximize your profit instead of minimize your profit, you need to make sure that you are on the increasing section of your marginal cost. If you are on the decreasing section of your marginal cost, then wrong choice, you minimize your profit. Okay. Now, what we are going to do is to distinguish between supply curves in the short run and in the long run. So in the short run, the individual supply curve is given by the increasing section of the marginal cost, which lies above the minimum of the ATC. So let's break it down. Let's start with the last section of this sentence, which lies above the minimum of the average variable cost. We understand why, because if the price is below the minimum of the average variable cost, the quantity supplied would be 0. So in this case, the supply curve is the same as the vertical axis. The increasing section, why do we have to be on the increasing section? Because again, if we are on the decreasing section, the profit, it would actually be minimized and not maximized. This is this second order condition. And why the marginal cost? Well, we can just go back a bit to understand why. Simply because we see that to maximize profit, we need to have MC is equal to MR. MR is equal to the price, so we must have the price is equal to the marginal cost. I will illustrate that graphically. It's going to be much easier to understand. That's the individual supply curve. And if I want to define the market supply curve, the industry supply curve, the only thing that I have to do is to add the individual supply curves. Each firm has its own supply curve. And if I add all of them, then I will get the market supply curve. Okay, let's have a look at that. So, same thing, I represent the usual curves, cost curves. And now let's try to identify my supply curve. Remember that sentence. The individual supply curve in the short run is the increasing section of the marginal cost. So this is the increasing section of the marginal cost, which lies above the minimum of the average variable cost. So that's my shutdown price, the minimum of the average variable cost. My supply curve is right there. The increasing section of the marginal cost above the minimum of the average variable cost. And what happens if the price is below the shutdown price? My supply curve is there, which means that I shut down, so I supply a quantity of 0. Okay? So I could take several points, several prices to emphasize why this is the case. So for example, if the price is there, let's just assume that the market price is there. That would be my individual demand curve. This would be my marginal revenue. Okay, let's write it. If the price is there, let's say MR1. In this case, I would maximize profit when MC is equal to MR. MC, it's right there. MR would be right here. So I would indeed produce this quantity of output. I would be on one point of this supply curve. If the price is, let's take another example. If the price is there, boom, why not? The price, market price could be anywhere. If the price is there, this would be my new marginal revenue, MR2. In this case, in order to maximize my profit, MC is equal to MR, I would produce this quantity of output. All right, I would have a second point on my supply curve. And you see that I can take any price above the shutdown price, and I would always the quantity that I would need to produce to maximize my profit would always be on this supply curve, on the increasing section of the marginal cost. But then if the price is too low, if the price is there, for example, right here, if the price is there, below the minimum of the average variable cost, then the price is below the shutdown price. So I am better off shutting down rather than staying in business. So the quantity that I would produce would be there. Okay. So this is the individual supply curve in the short run. You could even represent the market supply curve. It's a bit more advanced, but you could do something like that to explain how you can build it. So you could represent the individual supply curve, the short-run individual supply curve of one individual firm, okay, which is right there. You can give some figures. And then you could say that in this market, there are 200 firms. So you just have to multiply this supply curve by 200 and you would get the market supply curve. So for example, if the price is $20, each individual firm is going to supply 25 units. Which means that when you multiply by 200, and I think I made a mistake because 25 times 200, it's 5,000. It's not 500. Overall in the market, all businesses would produce the market supply, the short-term market supply would be 5,000 units at a price of $20. If the price is $10, each business is going to supply 20 units, and since you have 20 businesses in 200 businesses in this market, overall these 200 businesses will supply 4,000, sorry, it's a mistake, 4,000 units at a price of $10. And if the market price is $5, all firms are going to shut down. Each individual firm will shut down and produce zero. So the market supply at this price would also be 0. Okay, this is how you can move from the individual supply curve to the market supply curve in the short run. The long run things are a bit different, and it's actually less important to describe the supply curve in the long run for one simple reason, is that in the long run the price is always the same. In the long run the price is always equal to the minimum of the average total cost. So the concept of supply curve is not very relevant, because what is a supply curve? It's a relationship between different market prices and different quantities. But in the long run, because the price is always the same, equal to the minimum of the average total cost, it doesn't make much sense to define and to talk about the long run supply curve for one individual firm. But still, we could do it. It would be the same as in the short run, but now the firm will keep producing as long as the price is above the minimum of the average total cost rather than the minimum of the average variable cost. So again, I don't want to spend too much time on this long run individual supply curve, simply because we know that in the long run, the price, let me identify it, the price is always going to be equal to this value. Boom, price is always going to be there. So it's not very interesting to describe this long run individual supply curve. On the other hand, it is worth it, especially for those teaching AP, not really for Cambridge, but if some of you teach AP, it might be interesting to describe the long run market supply curve. Let's have a look. Okay. All right, I will start with a long run equilibrium. You see, so this is my short run market supply, this is my demand curve, and you see that the price is such that the price is equal to the minimum of the average total cost. So that's why I can see that this is a long run equilibrium where all firms make normal profit. Okay, so we start from there. This is our starting point. Now let's introduce a change. Let's just say that demand decreases for some reason. Perhaps there is a decrease in income, a decrease in GDP, or decrease in income in this market, so the demand for that product decreases. So we are going to have, in the short run, we are going to have a new market equilibrium, Q2, lower price, lower overall quantity. In this case, each individual firm that is in the market will face a lower demand curve, a lower price, so we have the downward shift of their marginal revenue, and they will have to adapt. They will have to adapt the quantity that they produce to maximize their profit. So now, in order to maximize their profit, or to be more precise, to minimize their loss, they should produce the quantity Q2, where MC is equal to MR. But at this level of output, you see that they make a loss. The price is below the ATC, and therefore they make negative profit. Okay, but you see that the price is still above the minimum of the average variable cost. You see the shutdown price, I haven't identified it. The shutdown price is there. That would be my shutdown price. The market price P2 is still above the shutdown price, so businesses, they keep producing at a loss. Okay, but in the long run, when we move from the short run to the long run, in the long run, they cannot sustain losses. So some of them are going to exit the market. So what's going to happen is that in the long run, businesses are going to leave the industry. So we are going to have a new short-run market supply curve. So basically, the only thing that is different between these two short-run market supply curves is the number of firms in the industry. We have fewer businesses, so that's why the market supply curve shifts to the left. The consequence is that the price is going to go back up and is going to become, again, equal to the minimum of the average total cost. And again, firms are going to produce Q1, same as before, and they will make normal profit. So you see that in this process, what happens in the market, we have moved from one equilibrium to the other. So I'm trying to identify, okay, so this one, we start from here. Okay. This is our initial equilibrium. This is a short-run equilibrium. Sorry, this is a long-run equilibrium because this is our starting point. This is our long-run equilibrium where all firms make normal profit. And then there is this decrease in demand. And in the short run, we move from this equilibrium, this long-run equilibrium, to this one. This one is a short-run equilibrium where firms make a loss. And finally, in the long run, when we allow sufficient time for firms to leave the industry, we move to another long-run equilibrium, this one. Okay, so this is what has changed in the market. We move from one equilibrium to the other. So then, if we want to describe the long-run market supply curve, which is simply the quantity of output that firms are going to supply in the long run, it's simply going to be equal, let me graph it, simply given by this horizontal line. You see that in the long run, the price is always equal to the minimum of the average total cost. So then the quantity can change. You see that Q1 here, this is our initial market quantity Q1, which is different from the final quantity Q3. But regardless, the price, the market price, is always the same. So this is a particular case when you have a constant cost industry. You know that, again, for those teaching AP, that things are different if you face an increasing cost industry or a decreasing cost industry. In this case, your long-run market supply curve can be upward sloping or downward sloping. For those teaching the Cambridge curriculum, you see that you have the one step further star, which means that students will not be tested on that. So it's okay if you choose not to talk about the long-run market supply curve, and in general, the long-run supply curves are not very important. Just to help you identify what is important is this, the short-run individual supply curve. Your students need to know how to build, how to identify on a diagram, and how to build this short-run individual supply curve. The short-run market supply curve is not so important, and the long-run individual and market supply curves are not very important either. You can skip them. Okay, and I think I'm done. So let me just share one exercise that you can do with your students to summarize the main points on perfect competition, and this will be the end of this webinar. So what I do is that I give them this very standard diagram where I represent the main cost curves, and I ask them the following questions. At what price would the firm just make normal profit? What area would represent the fixed cost at this price? What is the shutdown price for the firm? Within what range of prices would the firm choose to operate at a loss in the short run? Within what range of prices would the firm be able to make abnormal profit in the short run? And finally, to identify the firm's short run supply curve. So let's do these questions one by one. At what price would the firm just make normal profit? You know that this is the case when the price is equal to the minimum of the ATC. If the price is above the minimum of the ATC, the firm will make a positive profit at the profit maximizing level of output. And if the price is below the minimum of the ATC, the firm will make a negative profit at the profit maximizing level of output. So this is the price PO at which the firm make zero economic profit, normal profit. Okay, profit is equal to zero if the price is there. Question 2. What area would represent the fixed cost at this price? Okay. So the fixed cost is, remember that you can put it this way. Fixed cost is just the average fixed cost times the quantity. This we know. And average fixed cost is just the average total cost minus the average variable cost. So average fixed cost is just the vertical distance that we have between the ATC and the AVC. Okay, vertical distance between the green curve and the blue curve at Q0. And I just have to multiply by the quantity to get the fixed cost. So that being said, we can easily identify it. Boom, the ATC is, sorry, I see I made a mistake. This is not the ATC, this is the A, I'll correct it right away. This is the AVC. That's better. All right. So this is the AVC, this is the ATC. The vertical distance is the average fixed cost multiplied by quantity. This is my fixed cost. And the rectangle below would be the variable cost at this quantity. And the entire rectangle would be the total cost. First question. What is the shutdown price for the firm? Well, you know it. The shutdown price is the minimum of the average variable cost. So P lower bar is my shutdown price, minimum of the average variable cost. Okay, we got it. Within, let me erase that. Within what range of prices would the firm choose to operate at a loss? So they make a loss, so profit is negative. So we know that the firm will make negative profit when the price is below PO, because they make zero profit when the price is PO, minimum of the ATC. So whenever the price is below PO, the firm will make a loss. But the firm will not always choose to stay in business when the price is below PO. The firm will choose to stay in business only if the price is above the shutdown price, P lower bar. Okay, so the range of price for which the firm makes a loss but chooses to stay in business is this one, between P lower bar and PO. Simply because for this range of price, sure, the profit is negative, yes, but it is greater than minus the fixed cost, the loss that I would make if I decided to shut down. So I am better off staying in business. Within what range of prices would the firm be able to make abnormal profit in the short run? Well, remember, abnormal profit is just positive profit. The firm makes zero profit when the price is PO, P0. The firm will make positive economic profit as long as the price is greater than P0. And final question, identify the firm's short run individual supply curve. This one is important. Remember, the individual supply curve in the short run is given. This is really a sentence that your students must know by heart. It's given by the increasing section of the marginal cost that lies above the minimum of the AVC curve. So here's my supply curve. Increasing section of the marginal cost above the average variable cost. And again, you could, it's not mandatory, but I like to add this vertical section just to remind the reader that if the price is below the shutdown price, then the quantity supplied is zero because the firm shuts down. So I like to add this vertical section. This is my individual supply curve. You could even add something like that. I'm going to try to find the right color. It's not going to be exactly the good color, but you could even add something like that. Yeah, to represent your individual supply curve in the short run. I think it's a good exercise that summarizes many different things that your students, many skills that your students have are supposed to have acquired. So yeah, I think it's a good conclusion to perfect competition. Right, and I think that's done. I don't think I have anything else. And then there are, of course, the MCQs and examples of essay questions. Good. Do you have questions? Is there anything that is not clear? Anything that you would like to ask? Any particular issue, any question? We are now done with perfect competition, and the next webinars will no longer talk about that. So if you have anything to ask about perfect competition, do it now. Any particular question about MCQs, about essays, about diagrams, about the content? Think about it. I will give you 2 minutes to think about anything that you find difficult to teach, perhaps to your students. And if you do have some questions, I'll do my best to answer them. No questions? Okay. Then tomorrow, again, I will probably have some time to continue with our webinars. Perhaps not the next days. Tomorrow, I think I will take a 2 or 3 day break. So then we'll continue. But tomorrow, I will probably schedule a third webinar on monopoly. Again, because there are many things to say about monopoly, I will break it into 2 parts, part A, part B. So tomorrow we will introduce the characteristics of a monopoly market. We will discuss the equilibrium, how firms make decisions in this market structure, and what else? We'll probably, yeah, and we'll do the comparison between monopoly and perfect competition in terms of efficiency, in terms of consumer surplus, producer surplus, and if we have time, we'll talk about the advantages and disadvantages of a monopoly. Why might it be a good thing, and what are the costs involved with such a strong market power on the supply side? Okay, if there are no questions, we'll stop here for today. Yes, I have recorded, Lini, I have recorded this webinar. And as always, I will share the recording on my Facebook page, on my YouTube channel, and on my website. So you will be able to watch the recording of this webinar, no problem. All right, have a good evening, everyone. I will share the information about tomorrow's webinar in a few hours. We'll talk about monopoly. Have a good evening, everyone. See you soon. Bye.